Hey y'all, it's Rich with Cross Country Mortgage. Happy Friday. The Fed speaks. That's right. Yesterday, the Fed met. Every 6 weeks they get together. They decide how are we going to screw up the monetary policy for this country. Jerome Powell, he screwed up again. He got it right. That's right. The Fed has said that, or they increased the Fed funds rate by 0.25%. Mortgage market, stock market, they all loved it. When he spoke, he said they were looking at potentially 2 more small increases in the Fed funds discount rate. That's 0.25 each time. Boom, boom. So we see that in 6 weeks and then again in 12 weeks. But the market doesn't believe it because what's been going on is all of the inflation indicators are showing that inflation is decreasing. Jerome Powell even said they're starting to see the effect of inflation decreasing. Oh my gosh. I guess that a stopped clock is right twice a day. But what happened today? Today, the labor numbers, the new jobs report came out, and the market hated it. Now, the market choked on the Bureau of Labor Statistics job report, which showed 894,000 new jobs were created. Now, of those, 666,000 of them, these new jobs, were part-time jobs. But when you go dig into the nernies, the nuts and bolts of the report, and this is pointed out by Barry Habib and the cool cats over at MBS Highway, almost 90% of those jobs were a statistical deviation, a statistical formula change that increased those numbers due to the population control effect. So what that means essentially is not 894,000 new jobs, just a great headline report. In fact, that 3.4% unemployment rate that people are going to be crowing about for the next couple of weeks, that's completely, in the language of my people, Bubba Misa. Malarkey, compost, poop. They don't exist. The real unstatistically manipulated unemployment rate's probably closer to 3.4 or 3.7, 3.8%. So rather than exceeding the expectations of this report, what happened? A couple of morons drinking a little bit of Jack Daniels sat there with their spreadsheet and said, ooh, hey, this doesn't look good. Let's go ahead and throw in some extra jobs here. We're going to make everybody happy except for the economy. So today, what's happened? The mortgage-backed securities market has choked. They basically have jacked up interest rates. Why did they do that? Because they're like, oh, hey, if we've got a great jobs report, then what's going to happen? The Fed's not going to be as slow at decreasing the rates. The other thing that's in this report is they're saying that month over month, the average household earnings have gone up. But, this whole thing has been manipulated. So I expect that after we have the market review the jobs report, dig into the numbers a little bit deeper, we're going to see things normalize next week. Over the next couple months, we are not really going to see a whole heck of a lot of changes. Rates are going to go up a little. Rates are going to go down a little. They're going to go up a little, go down a little. May 10th is the date. May 10th is the date that we're going to start seeing the downside of the inflation roller coaster, and we're going to start seeing very significant changes. This is why we're confident Q3, Q4 that we're going to see rates plummet. That being said, what's going on in the housing market? I'm going to tell you, I'm talking to a lot of my compatriots in the mortgage industry. February is going to be a huge month. January kind of sucked for a lot of folks. December sucked. November sucked for a lot of folks. But February is going to be a huge month. A lot of people are expecting to have a banner month this month. Applications were up last month. We're going to see a lot more closings this month. So it's going to be a really great month. This is the time to start making the hay. What happened last week? Well, year over year, closings are down 36%. Okay, yeah, that's to be expected. Remember, when you were locking rates in December of 2021, you were locking things in, the low mid threes. Now, in December of 2022, you are locking things in the 6s, in the 7s. If you were lucky, you got something that started with a 5 and you paid a bloody fortune for it. Showings, year over year. Showings were down just a little bit. It's not so bad, actually. Only about 8.5%. So we see a lot more people are interested in buying. Open house, the HAR.com listing views, or the weather we had last week, that may have helped the listing views because folks were on HAR.com a ton. In fact, the year-over-year numbers, 2 weeks ago, the listing views were down 30% year-over-year. Now they're only down just over 20%. So all of the indicators show us that the market is getting better. We think that this is going to be a great year. What we need to do is we need to focus. You want to buy now prior to the interest rates dropping significantly. Don't worry, we've got a great program that will assist you in refinancing later. We're going to be waiving our lender fees. You can see the information below. I've got a little banner there that you can click on. If you got any other questions, please feel free to reach out. Rich Bond with Cross Country Mortgage, 281-841-1723.